What's going on, guys? In this video, we're going to be talking about where I'm putting my next $10,000. It is an ETF that I recently discovered, and then I did some research on it. It's not so new, but it's new to me, and it might be new to you guys. It is the SPGP. It's the Invesco S&P 500 GARP ETF. If you want to know what GARP stands for, that is growth at a reasonable price. You can see right here, GARP. Again, the ticker is SPGP, and this is an ETF, pretty unique in nature, but its goal is to kind of give you a little bit more growth than the S&P 500, but not as much volatility as the Qs. At least that's how I'm seeing it. But I'm going to dig in now, and you're going to see exactly what I'm talking about. So before we really investigate this ETF, I just want to make mention to the S&P 500. I'm still on Finviz here. I'm going to be jumping over to a couple of different sites: Finviz, Seeking Alpha, TradingView, and then StockAnalysis.com, just to really help you understand all this. So today, as I'm recording this, it was October 26th. It's a pretty brutal day in the market. And you can see it was pretty brutal because of the Magnificent Seven. You got Microsoft, Apple, Google, NVIDIA, Amazon, Tesla. They all took a major beating. MasterCard. But it's mainly these big tech stocks, and Tesla, I guess, is really taking the S&P 500 down today, especially because when you look at the S&P 500, it is very heavily weighted in technology, and you could see the top 31% of the entire ETF is made up of these 10 holdings: Apple, Microsoft, Amazon, NVIDIA. You could read the list, but very, very tech heavy, very concentrated, or top heavy, however you want to call it. And that could cause some problems like today, where we're down more than 1%. It was a pretty nasty candle down. And as I'm recording this, it's been tumbling for the past couple of days or even weeks, I guess now. But what's nice about the new ETF we're going to be talking about, the GARP ETF, what does growth at a reasonable price means? It means it's going to be trying to find those stocks that are growing, that have a positive PE, a growing PE, but their EPS is not too high, or their PE ratio is not too high. So it has a nice low PE ratio, but it is growing, and it wants to try to capture that quick little growth, and then it rebalances every couple, I think every 2 times a year, maybe every 6 months. But if we just kind of dig into the details of it, this is on Invesco.com because it is an Invesco product, but we could kind of see how they summarize it. You could pause the video and read this, the product details right here. I'm not going to go too much into that. What I want to do is first jump over to performance, and here's a nice little chart. This is since 2014. Now, I'm going to give you a disclaimer in a couple of seconds, but you could see over the past almost 10 years, call it, it has been outperforming the S&P 500. However, it restructured, you could see right here, in June of 2019. So at first, it was actually RAFI, and it was a an RAFI fundamental large growth index. And then they restructured it into this GARP ETF, and they started in June of 2019. Now, what's unique about June of 2019 is it got to experience the COVID crash right here, the 2021 bull market, or rally, whatever you want to call it, then the 2022 bear market, and now 2023, where it's been super choppy. We haven't seen all-time highs, but we did have a pretty good run-up. So we could compare it, really gave it a nice stress test between those three events. And if we jump over to TradingView real quick, we're actually going to go to when it started, when it restructured, which was 2019 in June. So it was, we'll just say we're going to jump to July to make things easy. I don't know the exact date in June, but that's close enough. So here it is. This is adjusted for dividend reinvestment. It does pay a nice little dividend, I think like 1.5% right now. It's up over 60% in the past, call it 3 years. Let's compare it to the S&P 500. And you could see it's beating the S&P 500 by a decent margin. So the S&P 500, since the inception of this, or since the restructuring, I could say, it's beating the S&P 500 by about 12%. You could see it pretty much mirrored the COVID crash. And then you could see all throughout 2020 and 2021, it was able to outperform the S&P 500. What was really unique as at the top, it did not have as much of a drawdown as the S&P 500. And now it's after it kind of bottomed in October of last year, it is beating the S&P 500. If we look year to date, the S&P 500 is up a little bit more. If we look in the past year, they're pretty much neck and neck. And again, I don't want to look past more than June 2019, because even though it's beating it here, this was before it had that structure. So I think it's only fair that we look at when it actually had its restructuring. We could look right before the COVID crash, it beat the S&P 500. After the COVID crash, it still outperformed. So there are a lot of different time frames we could look at. Here's the peak. So this was the market top during the bear market, and then it's run up in 2023. It is currently slightly beating the S&P 500 by a little. So now you may be wondering exactly what's under the hood, what's going on here. It's much more, well, I can't say it's much more diverse than the S&P 500 because it's only made up of 75 different stocks, but it's much less concentrated at the top, and the top is not tech. So we're going to jump over. I'm actually going to jump back to the S&P 500 really quick. Remember, more than a quarter of it is technology for the S&P 500. Then healthcare, then financials, and then all the others. And 31% is its top holdings right now. Its top 10 holdings make up 31% of the ETF. So you can say that it's very concentrated, very top heavy. Apple and Microsoft alone make up over just about 13%. That's insane. More than 10% just in two stocks. So what does the GARP look like? What is it made up of? Now we're on the GARP. Let's go over to holdings and check this out. Energy is its top sector, then technology, then basic. We got healthcare, industrials, and then the rest. And look at this. The top 10 is only 20% of its entire ETF. And you got to remember, there's only, right here, it says 78 holdings as opposed to 500 in the S&P 500. And you could see right here, the top two are only 5% of the actual ETF. Not a single one is over 3%. The top one, Diamondback Energy, isn't even 3%. It's only 2.5% of the ETF. So it's a lot less concentrated at the top, which I really like. And now, again, what I think is really cool is how it is structured. And I'm sure we could dig into here and figure out exactly how it's structured, but pretty much what I've been reading is it will take the top 150 stocks that have positive growth over the past 3 years, and then from that 150 within the S&P 500. So you start with 500 stocks, they narrow it down to 150. Then out of that 150, they're taking the 75 with the best PE ratio. So they're going to make sure you're not overpaying for it, and that's why it's growth at a reasonable price. And that's how the ETF is made. We could actually do a little bit of our own investigation. And if we jump back to Seeking Alpha, if the top one is Diamondback Energy, let's take a look at that stock. So here's Diamondback Energy. We have a forward PE ratio of 9. That's pretty good. If we jump over to stock analysis, let's take a look at its financials. And you could see from 2020 to 2021 to 2022, you could see some revenue growth. But again, I think they look at EPS, I believe. And you could see that is some really good growth right there. If we look at the little chart, that's incredible growth. So that's why this ended up being filtered into that ETF. And let's see, where is the PE ratio? Here we go, ratios. So we can see the PE ratio since 2020 kind of went up a little. It's kind of a good motion right there. But maybe it is that they look at the EPS. So they look at the EPS and they make sure that the PE ratio is not super crazy like something like NVIDIA. NVIDIA isn't even in this ETF. And I think that's really cool for the fact that this is pretty much doing just as good as the S&P 500, if not a little bit better, depending on when you're looking at it, especially if you're looking at the restructuring. And it isn't made up of the Magnificent Seven or all these tech stocks. There are tech stocks in it, don't get me wrong. And for the fact that it restructures every 6 months, I believe, sure, maybe NVIDIA was on it back in early 2020 or maybe 2022 when NVIDIA was down a lot. I'm sure Meta was probably on here because Meta had a pretty good PE ratio back in 2022 at its bottom. So it's picking up those distressed stocks that have strong balance sheets, and it's pretty much capitalizing on those swings at that 6 month uptrends that they're getting. And clearly it's working. So again, I would highly recommend, this isn't financial advice, but if you're shopping for ETFs, this might be something you may want to put on your radar. You can see right here, it's index history. So it doesn't have 5 or 10 years because it was restructured, but you can see 16% a year over the past 3 years, as opposed to the S&P 500 being only 10%. The past year, 23% as opposed to 21. And then right here, right now, year to date, the benchmark S&P 500 is beating it slightly. But again, if those big tech stocks, the Magnificent Seven, really take a beating, it's going to drag the S&P 500 down, and the GARP isn't even going to feel it because it doesn't have any of those stocks. So again, check it out if you are interested in it. I think it's a nice change of pace if you're looking to diversify. And before I go, the very last thing that people like to see is, let's go to summary. Right here, it's expense ratio. It's a little pricey, 0.34%. That is because it's a little bit more actively managed than, say, the S&P 500. But it is better than other growth ETFs that definitely aren't performing as well. Like, say, the ARK ETFs, that's 0.75%. So the expense ratio is a little pricey, but so far it's been working out for them, at least over the past 3 years. But let me know what you guys think. You think this is a cool stock? Have you heard it before? Is it something you may add to your investing strategy? And yeah, as always, guys, I will see you in the next one.